And we're now looking at the forms in this other category, specifically this journal entry form. And I want to talk about this one a little bit in more detail in terms of when we would use it, why we would use it, how you sometimes get some confusion, and how you might communicate with different people that you're going to work with within the accounting process. So remember, the general idea is if there's going to be something that is repetitive in the accounting cycle, most of the accounting process being repetitive, nothing being exactly the same typically, but it's going to have a system that repeats to some degree, then the system will create a form for it. Why? Because that's going to make the data input as easy as possible, and the forms can also create some links helping us to communicate with the people we need to deal with as accounting department or bookkeepers, that being customers, vendors, and employees. So that's going to be, of course, our invoice forms, our receipt payment, our expense forms, our check forms, and so on and so forth. But sometimes we're going to enter transactions that aren't normal. They don't happen all the time. And so there's not going to be a form for them possibly, and therefore we might have to default to the journal entry form. Now that will typically be ones that don't have cash involved, because if cash is involved, you would think that we could still use an expense form if cash is going out, or a deposit form if cash is coming in, even if the transaction isn't normal, doesn't happen all the time, such as, for example, a loan from the bank. Or, for example, the owner putting money into the business. Those don't happen all the time, but because cash is impacted, I can probably still use the normal forms for increases and decreases to cash. So you would think that it would have to be a transaction where cash isn't affected and it doesn't happen all the time. In other words, sometimes there's forms where cash isn't affected, but there's still a form for it, such as an invoice, for example, where accounts receivable is going up instead of cash because you haven't got paid yet, but of course there's still going to be a form for it. So it would have to be a transaction that doesn't happen routinely and doesn't involve cash, which might be something like the purchase of equipment that we finance, for example, meaning now cash isn't impacted because we took a loan for it, but we didn't get the money for the loan that's going to go into our checking account, so we can't use a deposit form. Instead, we might have to use like a journal entry form. The other primary example is at the end of the year, we might have adjusting entries to try to get on the specific timing entry basis that usually is the accrual basis, and typically that might be done by the CPA firm or tax preparer for tax preparation and or financial statement preparation at the end of the year. Now, I just want to look at the terminology quickly since we're looking at the journal entry form, because this is important for communicating with people. So if you come from, say, for example, studying in a book, a textbook at like a college or whatever, and then you move into bookkeeping or accounting, you're probably going to be overthinking in terms of debits and credits, which is basically what a journal entry form is, because that's what you're trained in. That's the building block. Debits and credits are easier to think about than the accounting equation, assets equal liabilities plus equity, when you're trying to construct things just from the raw data input of each transaction. But when you communicate with people in the accounting department or bookkeepers and or bookkeeping, then they're not often going to be thinking in terms of debits and credits. They're going to be thinking in terms of forms, how those forms impact the financial statements, and the financial statements are constructed in terms of the assets equal liabilities plus equity, the accounting equation. So that's kind of how you want to be communicating typically. And if we're in the bookkeeping process and we learned software before debits and credits, or software is basically what we know from data input, then we know most likely how the forms interact with each other, how they help us to communicate with customers, vendors, and employees, and the impact possibly of those forms on the financial statements being constructed in terms of the accounting equation, the balance sheet, assets equal liabilities plus equity. But you have to note that when you talk to the CPA firm at the end of the year or tax preparer, it's quite likely that their mind isn't really geared towards each of the forms. They're probably not thinking about communicating with customers, vendors, and employees as much. They're just thinking about getting the financial statements right to make the taxes and or the financial statements for external reporting purposes. So they might do their adjusting entries and not be mindful of the form impacts and the impacts on the subledgers and whatnot within the QuickBooks system. So you have to kind of be able to communicate with those people and realize that they're not looking at it quite the same way oftentimes. So that's going to be the idea from the bookkeeping side of things. When we're doing the bookkeeping and or accounting, the journal entry form is the last form we want to use. Debits and credits are used in all the data input forms, meaning those are the building blocks behind the scenes. It's not like accounting software got rid of debits and credits. You can still think of the entire double entry accounting system in terms of debits and credits. It's just that the forms make it easier to do the data input, make the debits and credits entered automatically, and they can present without debits and credits. They can present in terms of the accounting equation, which is actually kind of less efficient, but easier to communicate to more people in, because the formula format is known by more people, even though it's not quite as efficient as debits and credits. And the forms have the added value of being able to tie in properly to the subledgers, like invoices tying in not only to the general ledger account, but the subledger for accounts receivable, and to tie into forms that are going to follow it in sequence within a cycle, such as the invoice being followed by the received payment form and those forms being linked. So from an accounting standpoint, we're going to say, if there's a transaction, is there a form for that transaction? If we don't know the form for the transaction, we're going to ask, is cash affected? If cash is affected, then I can typically use an expense form for a decrease in cash and a deposit form if there's an increase in cash, even if it's not a normal transaction that happens all the time. And if there's no form that's going to be used and cash is not affected, only then would I typically want to use a journal entry form. Okay.